Welcome to the Mellafella Crypto Channel. I'm the Mellafella, back to share my adventures in crypto with you. Be aware that this is not financial advice. I am not a financial advisor. Also, it is cold in these crypto streets. So always do your own research. Invest no more than what you're willing to lose and protect your things. Yesterday, I posted some of my crypto goals for 2023. Which included staying informed by keeping connected in project communities, streamlining my profit and loss tracking process, and sharing what I'm learning along the way. This video sets out to do that by sharing a Medium article written by a member of the Safuu and Vulcan communities by the name of Dio on a better way to approach rebasing protocols as an investor. This resonated with me because I'm in the process of creating a tracking sheet for the rebasing projects that I'm in that will let me forecast and plan for profit taking, even if price falls, which in most cases, it will because they are deflationary in nature. I've done a mock-up using my Safuu experience from last year so far and was excited to see that Dio's approach just took what I was thinking about to a whole nother level. I was focused mostly on price and the amount of tokens that I had and time that I sold those tokens. I wasn't trying to time the market or anything like that, but I had a set interval where I would sell, every other week. I would make a sale of my Safuu to take profit. I've always taken profits in projects like that. So what Dio is doing is adding some method to the madness and looking at how to analyze the profit of rebasing projects as well. So that really resonated with me very well. So hope you get something out of that. Another thing you'll see is you'll get a view into how I research things. As you see, as we scroll through the article, I'm going to have highlights throughout this article. I do this to confirm my understanding of terms and words that are used and in the context of how that they're used, even if it's a term I'm familiar with. I'm not going to read this article. I'm going to let Speechify do that, but be aware Dio is promoting a product in this article. However, the content is still very valuable. So I've also included links in the description area to the article as well as Dio's Discord group. Thanks for watching. Hope you get something out of this. And please like, share, and subscribe. Mellafella is out.
Introduction to the ZeroXPA project. Please join us in our Discord server by clicking the link below. ZeroXPA. In order to understand the benefits that the ZeroXPA project can provide to the Vulcan blockchain investor, we feel it is necessary for those investors to understand the basic mechanisms which underpin the Vulcan blockchain protocol. Having a basic understanding of these mechanisms is essential to good financial decision making in regards to a rebasing protocol. We will begin with understanding the automated market maker, AMM. Next, we will discuss rebasing. After that, we will cover the circulating supply, then we will cover the basics of the Vulcan blockchain. We will start to put all of this together with a breakdown of price and profit and the problems faced by the investor when using price as indicator of both protocol and portfolio health when rebasing mechanics are involved. Finally, we will propose what we believe to be a better way. Automated market makers, AMMs, are decentralized exchanges that use algorithms to provide liquidity for traders buying and selling crypto assets. AMM-based DEXs provide deep liquidity for a wide range of digital tokens and coins. Automated market makers, AMMs, explained, Chainlink. What is an automated market maker? Automated market makers, AMMs, are a type of decentralized exchange, DEX, that use chain.link. Waffle Swap on the Vulcan blockchain will employ a constant product automated market maker. In a constant product automated market maker, liquidity providers make deposits for a trading pair of tokens in a smart contract. Those liquidity providers accept trades against their portfolio in exchange for a fee collected by the AMM. The smart contract determines the price of the assets being traded with the formula XY equals K, where X equals reserve asset A, Y equals reserve asset B, K equals the value of the product of XY. Fees taken by the AMM on each transaction increase the value of K, which thickens the liquidity and prevents volatility. It is the change in the ratio of XY or YX which determines the price. For a more in-depth analysis of constant product AMM, see the link below. Constant function market makers, de fees 0 to 1 innovation. In many markets, there may not be enough organic liquidity to support active trade. Market makers are agents that alleviate this problem. Medium.com. Rebasing. Rebase, to establish a new base level or baseline without changing the underlying meaning or value. In DeFi, when a coin or token is rebasing, a new baseline of circulating supply is created which increases periodically at an established percentage rate relative to the previous circulating supply. These periods are called epochs. The circulating supply includes all coins or tokens held in all wallets as well as coins or tokens in their respective side of the liquidity pool. For example, circulating supply equals 100 tokens. Rebasing rate equals 2% per epoch. Epoch equals 15 minutes. The circulating supply will increase 2% every 15 minutes as follows: 100, 102, 104.04, 106.1208. It is very important to remember that the token or coin LP rebases along with the rest of the circulating supply, which ultimately affects the price per token. Rebasing is not interest. You are not making money off of lent or borrowed money. Interest, money paid regularly at a particular rate for the use of money lent, or for delaying the repayment of a debt. When rebasing, the overall circulating supply of the asset invested in is increasing at a given rate while the underlying total value that the circulating supply of the asset is able to demand in exchange stays relative to the ratio of the token pair which makes up the liquidity pool inside of the AMM. Rebasing is a dilution event akin to a stock split. The rebasing curve. The rebasing rate of a token or coin is typically calculated using the compound interest formula. A equals P1 plus R/NNT, where A equals the final amount, P equals the initial balance, R equals the interest rate, N equals number of times interest is applied per time period, T equals number of time periods elapsed. If we go back to our previous example, P equals 100 tokens, R equals 2, N equals 96, since there are 96 15-minute periods throughout the day. T equals 1, since we are only looking for 1 day worth of rebasing. If we complete this formula, we will come up with a result of 723.87719747 tokens at the end of the day. But what happens if we were to do this calculation epoch by epoch and plot it on a graph? The rebasing curve begins to emerge. Now what happens to the graph if we extend this to 2 days? As you can see in our exaggerated example, the circulating supply is increasing exponentially over a very short period of time. But as we've stated previously, the underlying value of the total circulating supply more or less stays the same. So what effect does rebasing have on the price? The price depreciation curve. We can calculate the price depreciation curve of a rebasing token or coin with the same compound interest rate formula that we use to calculate the circulating supply increase due to rebasing, but with 2 small adjustments. A equals P1 R/NNT. P equals now is the initial price of a single coin or token beginning at day 0 hour 0 of protocol launch. And where there once was A plus, there is now A. So let's make the value of P equals $9 and let's plot that out on a graph the same way we plotted the circulating supply increase. Notice any similarities between this curve and the rebasing curve. They are near mirror opposites. The price drops from $9 to 16 cents over the course of 2 days. Now what happens to the market cap if we multiply the rebasing curve point for point by the price depreciation curve? As you can see, the market cap, calculated by multiplying the circulating supply by the current price, starts at $900 and drifts down to $828 instead of remaining flat, showing a net loss in value of the market cap over time. Keep in mind this is an exaggerated example. With a lower rebasing rate per epoch, the depreciation curve happens a lot slower over a longer period of time, and so does market cap depreciation. However, over time the effect of rebasing on both the price and the market cap is the same simply because of the math. Circulating supply. Circulating supply refers to the number of cryptocurrency coins or tokens that are publicly available and circulating in the market. We define two types of circulating supply: the static circulating supply and the dynamic circulating supply. The static circulating supply. The static circulating supply is the circulating supply that has a low to very, very low probability of interacting with the automated market maker. The temporary static circulating supply, along with coins that have been sent to dead wallets or wallets that can no longer be accessed and can no longer interact with the automated market maker. The permanent static circulating supply. Temporary static circulating supply. The temporary static circulating supply can be thought of as the diamond hands or hodler supply. This is supply of an asset that is being held for long-term investment. Permanent static circulating supply. The permanent static circulating supply can be thought of as burned supply. This is supply that is either inaccessible, where the wallet mnemonics have been forgotten or a wallet has been left derelict and forgotten, or supply that is otherwise unable to pass through the automated market maker and is no longer recognized as being part of the circulating supply, whether this is in actuality, in the case of a dead wallet, or in practice, in a case where the supply is being held in a wallet which is behaving like a dead wallet but is still recognized by the blockchain as being part of the circulating supply. The dynamic circulating supply. The dynamic circulating supply is the circulating supply that has the greatest probability of interacting with the automated market maker. This supply is the supply being held by those looking to take regular profits, supply held by risk-averse investors, supply held by swing traders, or any supply with a high probability of fluid movement through the AMM, including supply in the liquidity pool. The market cap and the liquidity pool, LP. The market cap of a coin or token is the circulating supply that is still being recognized by the blockchain, all coins or tokens not in a dead wallet, multiplied by the current price. As we have stated previously, the price is determined by the AMM. In the case of a constant product automated market maker, it is specifically determined by the change in the ratio between LP asset A and LP asset B. Therefore, it can be said that the market cap is the value of the ratio of asset A to asset B multiplied by the circulating supply of the asset for which the market cap is being determined. When this is understood, one can see that the liquidity pool determines the value of the overall market cap with a representative sample size of the circulating supply. As such, volatility can be viewed as the amount of error present in the LP sample size for the volume the asset is being traded at currently relative to its token pair. Generally speaking, the lower the volatility, the lower the error present in the LP sample size for the volume moving through the AMM. Conversely, the higher the volatility, the higher the error present in the LP sample size for the volume moving through the AMM. Viewed this way, we come to understand that the thicker the liquidity becomes, the more accurate the description of the value per unit made by the AMM. Price versus profit. Earlier we have discussed how price is generated by the AMM. Traditionally, price and profit have been a one-to-one correlation. In the next two sections we will discuss what the traditional view of price and profit are, along with what problems are faced when applying the traditional view of price and profit to a rebasing coin or token. The traditional view of price versus profit. The traditional view of price and profit in regards to investing in assets are expressed in this way. The total amount of the asset you own multiplied by the price of that asset minus your basis, the amount you paid for the total amount of the asset you own, is your profit. Current price x token count, basis equals profit. Initial price paid per token x initial token count purchased equals basis. The problems with the traditional view of price and profit when invested in a rebasing protocol. Hopefully by now it is apparent there are some major problems with the traditional view of price regarding a rebasing protocol. 1. Circulating supply is constantly increasing. 2. Basis is constantly decreasing as personal coin or token count increases through rebasing. This makes it difficult to keep track of profits. 3. Price will undoubtedly fall over time as it becomes exponentially difficult for demand to outpace supply even with burn mechanisms in place. 4. Volume will never be able to burn away enough of the supply for the price to remain flat. 5. Human psychology takes the hardest hit in a rebasing protocol because the immediate expectation is that the price determines the health of the investment and people attach self-worth to their investments. However, the price can't help but fall due to the protocol mechanics, which invariably makes people begin to doubt themselves and their investment. 6. People become mentally and emotionally conflicted because they have an ever-increasing supply of tokens or coins coupled with an ever-decreasing price point. 7. As the price continues to decrease, people start to become resentful of their investment, which leads to massive sell pressure that becomes increasingly difficult to overcome. 8. Upon first glance, it would appear that nearly everyone, except those who ride the initial pump and then dump at the first hint of price moving in a downward direction, ends up losing. Could it be? Could it be that all of these negative aspects of a rebasing protocol are simply a trick performed by the underlying mathematics on the human psyche? Could it be that all of the problems listed here are simply because a rebasing asset does not fit within the traditional view of price or the traditional way that price is used to determine protocol and portfolio health? The Rebasing team feels that we can definitively prove this to be the case. A better way. All of the things that make a rebasing protocol so frustrating to so many people are also the same things that make the price on a rebasing coin or token highly predictable. By taking into account circulating supply, rebasing rate, price depreciation, volume, circulating supply burn, price, we have been able to build a statistical model which can project price action within a range based on volume. Backtesting on protocols with the same or similar token mechanics as $vol has shown that our model exhibits a 90% correlation to both the high and the low of a given daily bar. When applying individual wallet holdings to the price model, something interesting begins to emerge. We are now able to see the true profit curve on this investment, as well as clear buy and sell signals alongside clear price direction signals as they relate to profit. This is the Rebasing profit model. These signals not only allow the investor to maximize their profits but also to take profits in a way which maximizes any future profit potential by empowering the individual to swing trade $vol, something that would be next to impossible to do profitably without this tool. This tool also shows that it is profit, not price, which is a better indicator of overall protocol and portfolio health. This is clearly demonstrated in the following example. The two images above show the all-time high, ATH, clearly marked. With the traditional understanding of price and profit, one would be led to believe that the most ideal time to take profits is when the price is the highest. Nothing could be further from the truth. It is quite clear that the best time to take profits is nearly 60 days later when the price is close to $100 lower. The model also clearly shows that as the profit curve moves above the upper band, there is an ever-increasing risk of the price undergoing a significant correction to the downside. Furthermore, true profit curve movement outside of the upper range is an indication of how much people are holding. Specifically, it is indicating that price, as it relates to profit, is above the statistical range supported by the volume alone. We call this the Hodler effect. We can see a second demonstration of the Hodler effect which begins nearly 2 months after the all-time high profit area. This area of major profit opportunity is nearly as significant as the first in terms of the height of its peak. However, by focusing on price, the opportunity would have been missed. The key. With our simple, innovative, easy-to-follow indicators, we are able to empower every level of and type of investor, from swing traders to the most diamond-handed, to make better financial decisions when investing in the Vulcan blockchain. By empowering investors to make better individual decisions about their investments, the Rebasing project will improve the overall health of the Vulcan blockchain protocol, increase investor profitability, and increase blockchain volume by presenting the $vol investor with necessary information to capitalize upon previously unseen opportunities inside of all other rebasing protocols. How it will work. The Rebasing project is currently in the middle of development and is composed 3 parts: Rebasing Cloud, Rebasing.store, and the Rebasing DAO. Rebasing Cloud. Rebasing Cloud is our SaaS app which is currently under development. This will consist of our custom profit tracking indicators paired with a DEX screener, price chart, and other wallet tracking tools. Rebasing Cloud will utilize NFT technology as a fully transferable license and access key to our SaaS. The NFT keys will be available in different tiers, with each tier being granted a different level of access. The unique Layer 1 rebasing mechanics of the Vulcan blockchain allows us to take the risk on a unique hybrid business model. Software as a service without a subscription or the collection of private personal identifying data. Utilizing a hybrid of Web 2 and Web 3 technology, we are also able to offer the user both security and recoverability. ZeroSPA has created a multi-vector authentication protocol which both prevents access to the user's account should their NFT key be stolen, but also enables the user to report the theft as well recover their account by minting an account recovery NFT key which operates as the original. While on our end we are able to blacklist the original NFT key and lock it to the wallet that it was moved to, preventing the wallet from accessing ZeroSPA.cloud and preventing the sale of the stolen NFT key on the open market. ZeroSPA Store. ZeroSPA Store is where users will be able to mint ZeroSPA Cloud NFT keys to their wallets, find information, access future ZeroSPA projects, and purchase any other products that ZeroSPA creates. ZeroSPA DAO. ZeroSPA DAO will be focused entirely on continued development of ZeroSPA Cloud as well as research and development of new products and services. ZeroSPA DAO is not a community DAO. It is a private LLC which has chosen to employ a DAO business model. More information about new ZeroSPA member and project onboarding will be available in the near future.